Hello, everybody, and welcome to my show where I analyze stocks that are interesting. So, if you find that interesting, please consider liking the video and subscribing to the channel. I'm your host, Michael Duke, and very exciting video. Today, we're going to take a look at something that we did just a few weeks ago. Alliance Resource Partners LP, ticker ARLP. They released earnings this morning, and I am going to take a look at them and weigh in on my thoughts. In addition to that, for the first time today, I will be using a new tool that I have created for myself to be able to analyze stocks the way that I want to. So I'm going to begin using it in my analysis, starting with today's video. So without further ado, let's take a look. We recently discussed Alliance Resource Partners just a few weeks back. Just to remind my viewers out there, it is a coal mining operation primarily. There's mines located in the central Illinois basin, and the Appalachian area of the United States, along with several port terminals for the export market. In addition to the coal operations, the company has a portfolio of mineral interests in oil and gas, meant to diversify away from just pure play coal. And then, furthermore, the company also has a small Bitcoin mining operation, giving it small balance sheet exposure to Bitcoin as they, mine the Bitcoins and hold them on their balance sheet. However, uh, from time to time, management has said that they will sell the Bitcoins if prices are good enough and they need the liquidity. I also, wrote this detailed article on Seeking Alpha, published on April 9th, of which I graded it a buy and summed up my initial thoughts there. Basically, my belief is that there's a long-term structural imbalance with the value of energy sources like coal, uh, the current pricing of them relative to the value that they have. There's a lot of emphasis right now on electrification, which paradoxically boosts demand for coal, but also ESG concerns and movement to move away from fossil fuels towards renewable energy. However, my belief, my conviction is that the transition that the world, particularly the West, is trying to enforce on market participants to transition to clean energy, it will take longer than it is believed to take. Therefore, uh, the runway for coal as an energy source, I believe, is much longer and more lucrative than the market is pricing. So that's the long term thesis. If you do not have a Seeking Alpha Premium membership and you would like to get one so you can read my in-depth analysis, which sometimes is a little bit more succinct than me rambling up here on camera, then I provide my viewers with a discount to a Seeking Alpha premium subscription. I have the link in the bio. So if that's something that interests you and you want, the double whammy of my YouTube analysis and my written analysis and grades, then be sure to check that out. Since this article was published, and I believe the video we made on this was a few days prior, the stock has outperformed the S&P 500 by almost 400 basis points. Notably, a couple of days after this article was published, there was an executive order that the administration, signed into effect to ease regulatory burdens on coal production and establishing it as a strategic mineral. So that's something that we're going to take a look at as well. in regards to how management is discussing it. So before we take a look at the transcripts and whatnot, I want to just directly look at the numbers. So let's do that. This is how they release earnings information is through a press release on the investor relations side of the website. So I'm just going to skip through that and come here. So these first two columns are the first quarter of the this year and respective last year quarter over quarter change, which means this quarter over this quarter. And then we have the prior quarter. These numbers are a little confusing. Then we have the prior quarter from our current quarter. And then the sequential change there. So this says quarter over quarter, but this is year over year. Quarter over the prior year quarter is what these numbers are. And these are the quarter over quarter sequential numbers. So at our Illinois Basin coal operations, we had a slight decrease in the amount of tons that were sold and a slight decrease in pricing, about 4% lower pricing. Expenses were also slightly lower, but segment adjusted EBITDA had a dip of roughly 10%. However, over the sequential quarter ending in December, we had a 25% increase. And that's going to be a theme that we're going to see throughout most of this earnings report. Turning to the Appalachian coal operations, one thing to note about Appalachian coal and to reiterate is that Appalachian coal is more, it's worth more than Illinois Basin coal, but they sell a lot more Illinois Basin coal. So there's a 23% decrease in the amount of tonnage sold, but a 8.5% decrease in sales price, which these numbers here are pricing. They largely track with what we're looking at here with about a year or so lag. So just something to keep in mind. One thing to note is that expenses for the Appalachian coal operation were up 33%. So significant decrease in adjusted EBITDA. However, our expenses did decrease quarter over quarter. So we actually more than doubled our segment adjusted EBITDA from the prior quarter. So again, we have weakening year over year numbers for the coal segment, improving quarter over quarter numbers. And then, you see that translated in total coal operations. We had a 33% decline in adjusted EBITDA year over year in the quarter, but a 33% increase quarter over quarter. So the fourth quarter, I think it goes without saying that the fourth quarter of 2024 was pretty weak. That was the quarter that we took a look at in the prior video. Obviously, we didn't think negatively enough about it to give it a negative review as an investment prospect. But it is likewise encouraging to see improvement over the prior quarter, which was very soft. Now to move to oil and gas royalties, you see the barrel of oil equivalent here, roughly the same year over year, 7% increase over the prior quarter. And then we see here average sale price here, again, oil percentage ticking up towards half of the royalties in oil. Our average sale price here, we have, roughly muted year over year. We did have better numbers here quarter over quarter. One thing to note here, though, is that those numbers realistically will come in much softer next quarter, given that the price of WTI crude is over, it's either at or over $10 a barrel less than it was at the end of March, which is what these numbers reflect. So understand what you're looking at when you're looking at the oil and gas royalties here. I expect weakness in the upcoming quarter. Um, Moving to coal royalties, we see we had lower volumes in coal royalties and lower revenues, uh, lower adjusted EBITDA both year over year and on a quarter over quarter basis. Coal royalties, out of all of these businesses, have are the only business that declined quarter over quarter. But every single business here is showing a decrease year over year from the prior quarter. So all in all, obviously these results, they don't look super strong. It is encouraging to see better results than the prior quarter, which was fairly weak. Um, Now moving on to the full year guidance, this is how they guided for the full year. So I'm going to just compare to see if they've adjusted guidance. Here we have 32 to 34 and a quarter million short tons of total coal. That's what they're guiding to there. Here we are edging that up by 500,000 tons. They're guiding to an increase. Okay, so they're actually expecting coal demand to pick up throughout the end of the year. And while I did not expressly predict a explicit volume increase in my prior video, that tracks pretty well with the thesis in that the company has been experiencing some softness here at the tail end of this down cycle in coal. We had the huge commodity boom in supply chain mania of COVID, right? That sent coal skyrocketing. The unit price per share of ARLP skyrocketed off of that. And in the years since, we've seen coal prices come down quite a bit. But the partnership has used the excess proceeds to pay down a lot of their debt. They also increased the distribution significantly, and we'll come back to that. Guiding to an increase in volume, I think, tracks pretty well with where I think this is going here. Let's take a look at our prices. 57 to 61 on a total average weighted basis. They're keeping that guidance the same. I think what we glossed over was committed in price sales tons. They had at the time of this report 26 million that were already committed and priced for 2025, and 14.7 million we see here that they've already committed to sell 32.5 for 2025. So they've actually already exceeded. They will exceed, at least on paper. They should. The likelihood that they will exceed the bottom bound of this range is very significant, I would say. So these numbers here I find to look very well, even though we have very still fairly soft coal prices. We've already locked them in. We've already locked them in at these roughly these prices. So that guidance will remain. One thing that we need to monitor is these numbers dropped today for the prior week. We see here that the current spot pricing in Illinois Basin coal is $46.50, which of course is almost 10% lower than the low range of that guidance. So something to pay attention to is that coal prices right now, the spot market for Illinois Basin coal is actually weaker than what they have on paper to sell. So that could put pressure on prices as for 2026 as we move throughout the year. So that's something to keep an eye on in these reports for sure. Segment adjusted EBITDA expense 40 to So, that gives you an idea that we are expecting $17 per ton sold of coal of profit. So if I use my calculator here, we've already locked in. Sorry, I was looking at the wrong report, but the number's identical there. $17 times 32.5 million. So that's the amount that they have committed to sell to this time, multiplied by their margin that they're guiding to on the per ton. So that equals 552.5 million of segment EBITDA for the coal operation. Okay, that's how we need to take a look at this. The royalties business, I'm not going to do a corollary there. Actually, here's why I'm not going to price that out, okay? Because they don't give insight into what the spot prices into natural gas and liquids are there. Maybe I will dive into that a little deeper in the interim. So by the next time I review the earnings report, I'll be prepared for that. But I'm not prepared for that now, and I don't want to waste time on the video. But basically, one reason I feel comfortable not diving into that too much right now is because I just expect the royalty business to have weaker numbers through the end of the year, given how poor our oil price is right now. Okay. Again, coal royalties, very small piece of the business. One thing here, they did guide to the same numbers here, except they're saying that expenses will be a little bit higher on the royalties business. So again, expect weak royalty numbers through the rest of the year. On coal royalties, those numbers look identical with the exception of expenses. They're guiding to slightly lower expenses for segment adjusted EBITDA there on coal royalties. So slight tailwind to that potentially. And then here, all of these numbers, they're guiding to higher depreciation and amortization. That looks the same. Lower interest expenses, and then keeping growth CapEx the same and maintenance CapEx the same. Okay. The last thing we want to highlight here is we had, again, lower tons sold year over year, lower tons produced, roughly in equal proportions. So obviously that decreases our expenses when we produce less, although there is a floor there. So we have earnings per share of 57 cents. That's not really relevant. It's not really relevant given the fact that this is an MLP. What we need to look at is here. Here we have our distributable cash flow. Okay, so in terms of our distribution, they did declare a 70-cent per unit distribution, not a dividend, a distribution. Okay, what that equates to is roughly $91 million. Okay, that's their obligation. So you see here, they did not generate enough distributable cash flow in the quarter to fully cover the distribution. But the coverage ratio of 93%, significantly better than the prior quarter of 65%, where they only generated $59 million of distributable cash flow. However, still meaningfully lower than the same quarter last year, where we had a 1.5 times distribution coverage, which is incredibly strong. Lots of excess cash there to invest. So we now have two straight quarters where we are not generating enough cash flow to service the distribution. Another thing to note here, 155 million of EBITDA, while our coal segment generating 600, or excuse me, 550 for the whole year, slightly less than that. So our coal operation does not fully cover the distribution at today's volumes and today's prices. However, we did calculate that on 32 and a half. If they hit the high end of the guidance, it was 34,750. Then we're basically right there at the high end of the coal guidance. So here's the deal. Here's what I see happening. Okay, a couple things are going on right now, and this is where we need to dip into our. I'm jumping all over the place in my mind. I'm going to come back to the thought I just had because we need to take a look at this, particularly through the standpoint of I used ChatGPT here to give me some takeaways of the earnings call. This is what I wanted to highlight here. So, management had commented on, and here's the actual transcript. We'll take a look at that. They had actually commented that the executive order we mentioned, that is really the first, piece of good news and reinforcement that this company management team has gotten from the government in decades, really. Now, instead of trying to destroy coal, we have a government that is friendly to coal, regardless of your political affiliation. I think it's pretty straightforward that the regulatory risks that are normally present with a coal-related investment, the opposite is true, at least through the Trump administration here, which I find as being a bonus to my thesis, not necessarily the purpose of the thesis. Anyways, what they said was a recent capacity auction that the prices there suggest higher scarcity value for baseload coal generation. That's kind of like my long-term thesis about coal being pulled into the short term there. And then, of course, we have the straightforward demand surge for data center power generation. But a couple things here, and this is where I started thinking about this. Right here, we still have those high price contracts. They expect a 4 to 5% drop in realized coal price. Again, they're just looking at this number. That tracks pretty well with what I'm seeing. Potential future distribution cut. I think that's fairly likely given the numbers that we're looking at. And here's the thing about the distribution, okay? I do believe that the coal market will tighten over the next year, if not the next several years, and produce plenty of volume and plenty of cash flow for the partnership to more than pay for the existing distribution. However, the issue with that, put yourself in the shoes of management here, excuse me. The issue with that is that right now, at the current prices, we don't generate enough. We have enough cash, though, to be able to continue to fund the distribution. But the reason that it's probably not good for us to do that is because what just happened with oil prices. Okay, this is it just says crude oil futures. Okay, but I believe that this is an aggregate index of all crude, but you get the idea. See what's going on. Down 15% year to date. At one point in time, it was 78 a barrel. Right before Liberation Day, it was 72. Now 62. It had dipped all the way into the high 50s. Down 25% over the past year. Again, we had oil over $80 a barrel. In fact, right now, crude oil is at the lowest level since August 2021. one, and definitely back to, I don't know what the average is based on looking at this number, but we have pretty low crude oil prices right now. So obviously, I think it goes without saying that if you are ARLP and you are in the business of acquiring, partially in the business of acquiring mineral interests to grow and diversify your portfolio away from coal, then what better time to buy mineral interests than when oil has significantly sold off? That's right, because we have the price of oil hovering around $60 a barrel. That puts extreme downward pressure on the value of mineral interests. Okay, so if you're the management of ARLP, would you rather pay out distributions that are too high to your unit holders, or would you rather retain cash so you can scoop up mineral interests on the cheap? I would want here, they note here, acquisition activity for oil and gas royalties slow. In other words, the prices moved. The prices just kept moving. Again, this is our quarter starting here. Prices meaningfully declined, right? Two broad waves there. So I am of the belief, in fact, this is highlighted right here, where they discuss the distribution here, where we talk about a board warning. Trade tariff uncertainty will be monitored. Future distributions could be adjusted depending on impacts. Let's see if we can actually take a look at this. The board will closely be evaluating the potential impacts of tariffs on future results, which will, among other factors, inform the board's decision regarding future distributions. So here's the deal, folks. The appeal of this stock is primarily income based. However, I would not be surprised if we saw a distribution cut sometime in the near future. It might be as soon as next quarter. It might be several quarters out. Obviously, if you're the management team, particularly Mr. Joe Kraft. Joe Kraft has a ton of units, by the way, so there's alignment there with the unit holders, right? But if you're Mr. Kraft and management, particularly if you're the CFO of this company, then you would prefer to be able to do it all, to be able to keep the distribution where it is and have money left over to buy these cheap mineral interests, among other things. However, if you continue to have kind of softness in coal throughout the end of the year, and the outlook for mineral interests deteriorates further, again, that dampens your cash flow from the mineral interests on one hand, right? So you have less money coming in. They basically need, in order to not cut the distribution, they need to either issue units to be able to acquire mineral interests on the cheap, at a level that is accretes value. The fact that the current units are 10-11% yielding makes that expensive to do. Or they could issue debt, which honestly might be a better move. However, that would certainly dampen market enthusiasm, I think, for the units, given that one of the main appeals of the business is that it's has very low debt. So I don't mind if they cut the distribution. In fact, the last time they cut the distribution, the business was struggling quite a bit, and there was extreme volatility in the unit price. So I would not be surprised if there was a slight distribution cut in the near future. However, that does not dampen my enthusiasm for the units, given their long-term outlook. Here's their comments on that. On April 8th, President Trump signed 4 executive orders to expand coal-fired generation, seeking affordable electricity for the American people and grid stability. in anticipation of growing energy demand, which is critical for our country's national security interests. This is what we talked about in the last coverage here. The executive order addressing grid reliability cited that rapid technology advancement and expansion of AI, increased domestic manufacturing, are driving an unprecedented surge in electricity demand, placing significant strain on the grid. They forecast that demand for electricity is expected to rise 16%, or 3 times the growth forecasted just a year ago. These orders are designed to help level the playing field, inject common sense approaches to the calculation of reserve margins, and prevent premature retirement of critical generation. I think that's obviously of benefit to our units here. Regardless of your thought on the climate impacts here, I think we need to be very rational about how coal is potentially set up to boom here over the next few years, if not 10, 15 years. I think, again, that really what we're making is a bet on coal here. And it comes down to the risk reward here. The results are likely to be material for our customers and our industry. Recent analysis by Energy Ventures estimates that 10.6 gigawatts of coal plants scheduled to retire or convert to natural gas by the end of 2027 could be extended, representing coal demand of 23 million tons per year as a result of these executive orders. This includes a number of coal plants we currently serve. We have long maintained that premature closing of coal generating capacity would threaten grid reliability. We see there's a big power outage in Europe right now. I've seen a lot of chatter on X relating to the cause of that. It's not necessarily clear. However, the going theory right now is that the increased amount of reliable energy sources plugged into the grid, that does create more volatility in throttling when wind comes on and off of the grid. That's a super unintelligent explanation, but anyways, it does make a lot of sense if even in an economy where you have primarily renewable energy to still have reliable energy underneath the grid, or backing it up, backstopping it in the case of broad failure due to the volatility of renewable energy generation. Okay, so that's kind of more. The market has already signaled the scarcity value of coal-fired generation is evidenced by the capacity auction clearing price increasing tenfold. The next auction is indicating more of the same, with 350 per megawatt day price cap already announced. So we have signs. We have signs that the outlook is increasing strongly linearly, if not, somewhat, differentially here, that there might be an acceleration of demand in the near term. Okay, but then what they say here, while this policy momentum supports constructive long-term fundamentals, the initial fallout from the tariff announcements has created significant uncertainty as to the future inflation, supply chain interruption, global economic activity, and energy prices, making it difficult to predict with any certainty how these policies will impact us. So, the CEO of ARLP, a notable donor to the Trump campaign. So on the one hand, they say, yeah, hey, this is great for our industry, but also this tariff thing is creating tons of fallout, right? So kind of a subtle dig right there, I think, by management. As Carrie mentioned, we have secured solid volume commitments for 2025 and 2026. However, similar to this year, as our higher price multi-year contracts signed during 2022 roll off, our average coal sales price per ton is trending lower. Based on current market developments, including a favorable natural gas futures price curve, we anticipate that 2026 average coal sales price per ton can be 4 to 5% below the midpoint of our 2025 guidance. Like this year, we are hopeful we can maintain margins with cost savings. Trade policy uncertainty makes actual cost, sales opportunities, and pricing very hard to predict. So the issue with tariffs on the cost side here is this company does have exposure to like the steel and aluminum and stuff like that, stuff that might be an input cost to their coal extraction process. What we're basically looking at is units that are priced already to a degree that anything that has a double digit yield is conceivably priced that way because of a limited expectation for growth, if not a cut, right? So, in a lot of ways, the way where we're hovering now, where our forward yield is 10% plus, not as attractive as it was at one point in time at 13, 14%. However, we're priced at 10%. Even if they were to cut the distribution by half, you still have a yield in excess of 10-year treasuries. Okay, so I find the income prospects of the units to still be very compelling. Although I would not be surprised now if we did see a cutback in the distribution over the next 6 quarters. So if you're interested in these units and you're expecting to just make all this cash flow and it'll never go down, it'll only go up, maybe temper your expectations there and make sure you understand what you're getting yourself into. If that makes you nervous, then maybe don't, just know what you're doing there. I think since the last time I discussed this company, I believe that the outlook for the long term, the 5-10 year outlook, has become even more attractive. However, um, there's really nothing, with the exception of the auction that management discussed. There's really nothing right now in terms of the coal prices, um, in terms of the oil prices being down. Oil prices being down is somewhat of a leading indicator, right, for coal prices. Why would oil prices come down? Because demand is expected to come down, right? So oil prices coming down, while that does lower the royalty revenues of ARLP, I also think that it's somewhat of an ominous signal there on coal pricing in the very short term. That even happened before we did our most recent video. It's not something that I really fleshed out in detail, but I think it makes sense. However, I do believe that coal will be one of the better performing commodities in the go forward, given the way that geopolitics is, the monetary reset, the isolationist stance of our government. There's many, many reasons why I think coal will be a phenomenally well performing commodity. So, all that being said, if you are the type of investor that can withstand near term uncertainties, I still think that we're looking at a very, very interesting value proposition here. Okay. This is not financial advice and it never will be. Okay. There is a lot of risk in this investment. So just know what you're getting into. Okay. Exercise caution. Our distribution is not covered by cash flow. If we just break it down to how it has performed year to date, units have surpassed the return of the S&P 500 by 13.5%. Very strong relative outperformance. And furthermore, if we just take a look at the month to date, it's a little more muted there. We don't have today's returns included in this, which is, we're up big today. Market loves these earnings, by the way. We're up big on the day. The S&P is something off today. So while this is roughly a 3-point difference, we're actually at more of a 6 or 7-point difference in the month of April. Very strong performance. So now I would like to use my new analysis tool that I've developed, and it's a work in progress, to take a look more at these results. If you've been watching my videos for a while, you know that I like to, visually analyze correlation and that type of thing. Well, I'm developing a tool that allows me to do that. So, first off, um, let's take a look at our ticker here, and I'm just going to analyze that ticker versus the VOO, which is the Vanguard S&P ETF. So let's analyze our set here. So we see our correlation. Our correlation coefficient is pretty low. But now I want to analyze here our term. Okay, so here I'm regressing ARLP over VOO here to find my beta, alpha, R squared, and then how that might be changing over time. So to the end of what I was demonstrating, one thing I'm seeing here that I'll need to look into is the time period doesn't fit fully well. Or I guess we have our rolling window here of 30 days. So it fits just fine. So the fact that we have a positive alpha effectively means that ARLP has outperformed. We saw that visually in the chart. Beta is pretty low. We have a statistically significant beta there, meaning that, we do have a low beta here that is statistically significant to the index. Only 13% of the returns of ARLP are attributable to VOO here in the R squared. So these are, in my mind, excellent looking numbers. The alpha is not statistically significant, however. So it basically means that our alpha doesn't necessarily compute in the way that beta does. However, alpha is alpha, right? That's my opinion on it, anyways. We see here over the last 30 days, as of 425, we do have a very, very low, correlation there. We have a slightly higher correlation than over the year, and our beta is slightly lower. One thing I can do here is I can compress my time frames here, which again, the goodness of this data when we only have 5 observations in each window here for this bottom graph. Obviously, there's some error in that data, but you get the idea here. At significant times, or at 1, 2, 3, 4, 5 different instances during the period over a rolling 5-day window, we had negative correlation to the index and significant beta here. So the way that I interpret these results is that we have units that are meaningfully more volatile than the index, but have outperformed. If we look at that data now since the prior earnings report, let's take a look at that, more or less the same. So if you're familiar with these metrics, if you're a regular viewer of my channel, I routinely discuss concepts like beta, correlation, and stuff, but never actually calculate them. Sometimes I've pulled a chart from a tool like Portfolios Lab to make my point, or I've just visually tracked the price of the shares versus the index. I am attempting to take my ideas and actually calculate them visually. So that's what we're doing here. So I don't know if this is helpful or not for you, but I certainly find this to be extremely, extremely interesting because, again, the purpose of a lot of what I'm doing here in analyzing individual positions is because I want to outperform the index with lower risk, with higher income. Extremely, extremely difficult to do. Anyways, so to sum it all up, after digesting these earnings, the market certainly likes what they see. And I'll tell you what, I like it too. Okay, I like it too. I do think it further reinforces that we might see a distribution cut, particularly if they meet their very conservative guidance. However, the fact that they are targeting a volume increase and that they've already hit the low end of their guidance, still on these like older pricing structures, the fact that they've already locked in the lower end of their sales guidance in terms of tonnage, they increased that by 500,000. I think that that's very, very instructive to our thesis. I think the fact that we have oil prices coming down significantly creates kind of this standoff between unit holders wanting cash flow and management wanting to invest for the future. So I'm very eager to see how management discusses in the future earnings calls what our distribution coverage looks like, and if they cut the distribution, what they actually plan to do with that. Because what I really don't want to see is where everything's just weak and they cut it and it's not necessarily to free up cash flow to invest. I think if they cut the distribution and they were instead plowing all of that cash flow into more mineral interests that were at these like low prices. Obviously, there's risk in mineral interests at low prices. The production volumes are going to come down, but uh, oil recovers, right? It's a commodity, very strategic, important commodity. I think we're in a stagflationary environment, so oil will, continue to be a important macro asset throughout that outlook. So, anyways, despite the fact that we have some hints here and there that results aren't great, we're not covering the distribution for 2 quarters in a row, and a distribution cut might be incoming. I am not phased by these results. In fact, I find them very positively. I share my view with the market. Um, Another strong trading day for the units, outperforming the S&P 500 slightly in the red today, and the long-term outlook for coal as a strategic commodity in our quest for more energy independence and national security, I think, is very strong. I just think that the near-term uncertainty of the tariffs will create some volatility in their cash flows and unit price. So, if you share my views or are open-minded to them, just understand the risks. That's going to conclude our video for today. Hopefully you found this interesting. Be sure to leave me a comment below, and I will talk to you soon.